Alright, greetings traders. Once again, I welcome you to Precanic Trading Networks, the home of successful traders. Here, we educate, we enrich, and we empower. And do well to visit our website in case you want to get a proper mentorship on anything that has to do with trading. You can always go to precani.com as you see it on your screen. Welcome to Forex 105 Beginners Course. Take your time, learn the skill that will pay for the rest of your life. In order to get started, you need to have one thing in mind. I am a student always. Do not compare yourself with anyone else's progress. Always keep a winning mind frame and you will do very well in this business. Upon finishing this lesson, you should know the answers to the following question. Pending order, lot size, what is leverage? Now let's talk about the pending order. Now if you go to your MetaTrader 5 MT5, and if you don't have it, you can as well go and download the MT5. MT5 is the trading app. It allows you to execute trades after you've done your analysis. So these things are some of the orders that you can use to execute your trade. Now the reason why the pending order is very important, alright, but it is very optional at the same time, is because sometimes you could get busy as a trader and you may not be available to execute your trade yourself. So you can leave a pending order for your brokers to help you execute a trade in your absence. That's number one. Number two is in case you have any need to travel to areas where there is no strong network coverage, all right, you can as well leave a pending order to your broker to help you execute. And then lastly is when perhaps you are sleeping, all right, and you have already done your analysis and then you have decided a particular zone to execute the trade, but you don't know if that might happen when you will be sleeping. So you can leave a pending order so that when market gets to those zones, it will execute automatically for you, whether your phone is off, on, or low, or has a low battery, or is out of network. All right, as long as you have imputed or placed a pending order, it gets executed the moment market meets the requirement. Now, what is a pending order? A pending order is a requirement or a request. A pending order is a request made by a trader to a broker to say at which price level a position should be opened or closed. Experienced traders don't advise trading on the forex market without using pending orders, since they help to avoid significant losses. However, in a pending order, a trader instructs their brokerage or their broker to buy or sell a currency pair at a predetermined price. Pending orders are used to execute a trade at a position that will be achieved by the market in the future. There are 4 types of pending orders that can be placed for execution. We have the buy limit, the sell limit, buy stop, and sell stop. Now let me go and explain what they all mean so that you understand these concepts. Is that clear? All right. Let's just say, for instance, talking about a buy stop. All right, let's say for instance market is trending up, and then from the analysis you want to enter the trade the moment market gets to this price level. Let's just assume that this price level is $5. Do you understand? Let's just assume that this price level is $5. All right, so you can leave a pending order at a price at $5, for instance, telling your broker that, listen, whenever price gets to this place, put me in the market. I want to be buying at $5. Do you understand? So because you have seen from your strategy that the market will continue her bullish move, that is how we use pending orders. And don't forget that we also use pending orders, and then you also have to put your stop loss under your recent lows or whichever place you want to put your stop loss. Maybe let's say your stop loss is $3, all right, and then your take profit could be $10 or $15. Let's just say $15. That is, all right, 1:3 risk to reward. All right, So this is how it's being done. So the moment market gets to $5, it puts you in the market even when your phone is off, or when you are offline, or when you are sleeping, or when you are driving, or when you are in church. Whatever activities that has kept you busy during that time, your broker does the execution for you. Your broker executes the trade for you. Is that clear? So that is what a pending order is. So a buy stop order is a pending long order. Now in forex trading, when you hear the word long simply means buy. Long means to buy. And when you say you are entering a long order, it means that you're expecting the market to trend upward. Is that clear? Now when you hear the word short, as is when you hear the word short, look at it here, the word short, it means to sell. You're expecting the market is going to drop. Is that clear? Like price is going to drop. So these are the terminologies that we use to represent the buy order and the sell order. Is that clear? Yes. So let me quickly erase this so that we can go to the next one. So a pending stop order is an order or a long order that is placed above the current market price. Is that clear? It is placed above the current market price. So when price gets to your determined price of execution, it puts you in the trade. Is that clear? Yeah, so that is just that. And then let me quickly talk about the sell limit, the buy limit. Let me explain what a buy limit is. A buy limit order is. Now, a buy limit order is an order you place when the market is actually in a downtrend, and then you are believing from your analysis that, or you know from your analysis that when the market gets to a particular level, it is going to trigger for a buy. All right, so you set what? A buy limit order. Let's say buy limit order at $2, and then you're telling your broker, please, whenever market drops to $2, put me in the market, because I believe, or I know from my strategy and my analysis that it is going to go for what? A buy. Is that clear? So you put a buy limit, and that is why the definition says that a buy limit order is a long order or a buy order placed below the current market price. You understand? So that is just what it is. All right. And then the opposite is for the sell limit and the sell stop. Now what is a sell stop? It's just the opposite of the buy stop. Okay, let me quickly explain that. Now let's just assume that from your analysis you've seen that our market is going to trend maybe to this level. It's going to trend down to this level, and then you can put what? A sell stop order here, maybe let's just say at $4, telling your brokers that, listen, no, please, whenever the market gets to this $4, just execute the trade for me. All right, so what your broker does is what? They execute the trade for you, because you know that the market will continue to drop to maybe your take profit at this level. Let's just say your take profit here is $12. Is that clear? All right, and maybe your stop loss here is maybe $3. So now when you want to execute a pending order, you're going to ask the price. When you go to your MT5 or MT4 trading platform, once you click on any of the pending orders, whether it is sell stop or buy stop, you're going to see price, stop loss, and take profit. All right, so you're going to be the one to determine at which price do you want the broker to execute the trade for you, and what your stop loss is going to be, and what your take profit is going to be. Is that clear? So let me quickly say something before we continue. So this is actually a sell stop order. You place the order below the current market price, so that as price comes and triggers it, it executes automatically for you. Is that clear? Yeah, let me quickly explain something. Let me quickly explain something about these things so that you understand. Now, if for instance you have spotted a trending market, and then you you enter the market on the recent low, That is to say, you are buying, because buying means as price increase in value, you make money, you make profit. So, and then price increase in value. Let's just assume that this is your entry point. Your entry point here is $2. It means that your stop loss has to be below your entry point if you're going for a buy. All right, because your prediction states that you want to do what? You want the market to go up. So your stop loss is just right below your entry point, and your take profit is right above your entry point. Please do not forget this thing. It's very important. Your stop loss should be right below your entry point, and your take profit should be what? Right above your entry points. Let's just assume that your take profit is $6. All right, so you want, the moment the market gets to $6, it closes the trade for you automatically and add this $6 to your trading account. Okay, all right, so let's continue, guys. I know you now understand where to put your stop loss. Your stop loss should be below your entry point. All right, and then your take profit should be right above your entry point. Same for a sell. Let's assume that you are selling, all right, and your take profit is somewhere here at $12. Okay, and then you enter the trade here at $3, for instance. Then your stop loss should be above your entry point for a sell at, let's just assume that it's just $1 you're risking as a stop loss. So you believe that once the market gets to $12, all right, that is where take profit is. They're going to add $12 to your capital. Do you understand what it means now? So when you are selling, your stop loss should be what? Above your entry point, and your take profit should be below your entry point. And when you are buying, your stop loss should be below your entry point and your take profit above your entry point. Is that clear now? Because when you're buying, it means that you want price to go up. All right, so your stop loss has to protect you in case market decides to go against your direction. Do you understand? And when you are selling, it means that you want price to come down, so your stop loss has to be above your entry point in case price decides to go against you. So your stop loss saves you from losing money, or from losing money beyond what you have projected to lose on that trade, or what you have planned to lose on the trade. Is that clear? So I just want to use these terminologies for you to understand how this thing works. All right. So in case you don't understand all these things I'm saying, you can actually go to YouTube and search pending order and watch other content from other traders. Perhaps you may have a better understanding, or I would advise that you watch this video over and over again until you understand all what I'm saying. Is that clear? So now let's continue, guys. I believe I'm making sense. So a sell limit is a market situation, or is a pending order that, let's just assume that market is buying, or market is bullish, or market is trending up, and then you have seen from your analysis that when market gets to a particular resistance, maybe at $10, it is going to start to drop. So you can put what? A sell limit order at $10, indicating to your broker that, listen, whether I am there or not, once market gets to $10, please put me in the trade. Because to you, you believe that your analysis has already told you that price is going to start to drop once it gets to that $10. Is that clear? So that is what pending orders is all about. So for me, I prefer market execution. I execute my trade myself, and when I'm busy, I'm sleeping, I just don't go to my trading. I don't even execute any trade. All right, I don't execute any trade. Yes, because I just do market execution. So anytime I'm busy, or I know I'm going to be traveling, I just don't execute any trade at all. Okay, yeah, that is what works for me. But to other persons, they don't want to be the ones executing their trade. That is why they like to put pending orders, so that the trade gets executed automatically for them. All right, so now let's talk about, I mentioned stop loss, take profit, and market execution. Another name for market execution is instant execution. Another name for this market execution is instant execution. So like in case you see some brokers, they will prefer to use the word instant execution. It is still the same thing. All right. So while placing pending orders, it is very pertinent to ensure that you employ adequate risk management through the use of stop loss and take profit orders. Now let's talk about the stop loss. Like I told you, the stop loss is used to reduce losses if the price of a currency pair that you traded starts to move in an unfavorable direction. Now let's say, for instance, you want to buy, automatically your stop loss should be what? Below your entry point. So the reason why your stop loss is placed below, in case the market starts to sell, your stop loss protects you from further losses. Do you understand? And if you're selling, for instance, and then your stop loss should be above your entry point in case the market chooses to go in the opposite direction. Your stop loss saves you from incurring further losses. Now, what is take profit? Take profit, just as the name implies, this is used to limit the levels of profit if the price of a security rises to a specific level. So let's say, for instance, you're taking a trade and your take profit is just $10, and then you put it there at $10. The moment the market gets to your take profit, automatically it closes that trade for you and add your profit to your capital. All right, that's how it works automatically, whether you are there or not, because you've just left a pending order. Okay, yeah, you've left a pending order of take profit and a pending order of your stop loss, telling your brokers that, listen, in case market hits my stop loss, okay, just take me out of the market, and in case the market hits my take profit, please take me out of the market. So most traders don't use take profits, they only use stop loss, and they open their take profits because they believe that the market is going to deliver more profit than what they have already anticipated. Do you understand? So that is how it works. So that is why the forex market is a place where you have the right to do anything you want to do. All right, but as long as those things you're doing are serving you, you have to put them on reputation to make more profit in the market. So market execution is the most basic type of trade execution, and it is used to buy or sell securities. Now when you hear the word securities, we're talking about either forex, either cryptos, whatever, any tradable asset, all right, is a security, okay, at the current market price. Trades are executed at the current ask and bid price. This advantage of using market order is that it guarantees that the trade will be executed instantly or immediately. Now let's talk about lot size in forex trading. All right, forex is commonly traded in specific amount, and listen, this lot size is applicable to all tradable assets, whether it is commodity, whether it is forex, whether it is natural gas, whether it is cryptos, you know, anything that is tradable, whether it is stocks. All right, we normally do those things with lot size. Is that clear? So forex is commonly traded in specific amount called lots, or basically the number of currency units you will buy or sell. In the world of finance, lot size refers to a measure of a quantity or increment of a particular asset or product which is deemed suitable for buying and selling. Now let's talk about the types of lot size. We have the standard lot size, we have the mini lot size, we have the micro lot size, and we have the nano lot size. So a standard lot is the equivalent of 100,000 units of the base currency in a forex trade. Like I told you before in our previous videos about base and quote currency. All right, so a mini lot size is what? Is a currency trading lot size that is 1/10 the size of a standard lot size, which is basically 10,000 units. And then a micro lot size is the 1/10 of a mini lot size, which is 1,000 units. And a nano lot size is the 1/10 of a micro lot size, which is 100 units. Is that clear? Now, when you are trading forex, lot size usually starts with 1.00. This is for one standard. So it varies. It can vary up to 1,000 lots depending on your capital. All right, it can vary up to 1,000 lot size. All right, which is 1,000.00. Okay, so in forex trading, when you are trading with one lot, let's just assume that we are using 1.00 as the basic. This is the start of a lot size. All right, yes, anything lower than 1.00 is a mini lot size. Anything lower than 0.1 lot size is a micro lot size, and anything lower than 0.01 lot size is a nano lot size. All right. Now, in forex trading, one standard lot size means that if the market makes a movement of 1 pip, all right, if you check our previous videos, I say something about pip, so you can go back to Forex 104 or Forex 103 where I did a content on pip. Now let's just assume that the market made a movement of 1 pip. It means that it is measured at $10. If market makes a movement of 2 pip, that is $20. All right. If the market makes a movement of 3 pip, that is $30, as long as you're trading with 1 lot size. Then if you're trading with 2 lot size, for instance, it's still the same. To just add, and the market makes a movement of 1 pip, that is what? $20. The market makes a movement of 2 pips, that is $40. If you're trading with 2 standard lots, just that is how it works. All right. So just have it at the back of your mind that every 1 pip movement is equivalent to $10, as long as you are executing that trade with one lot size. So that means if you make a profit of 10 pips, for instance, let's say you made a profit of 10 pips in the market, automatically you've made $100 profit. All right, let's say you made a profit of 10 pips with one standard lot size. That means you've made $100 profit in the market. I hope this is clear. All right. So now for a mini lot size, it means that for every 1 pip, movement is equals to $1. For every 10 pip movement using mini lot size is equals to $10. You understand? For every 100 pip movement is equals to $100. And I told you, like, it can vary. A mini lot size can vary from 0.1 to 0.9. This is the max a mini lot size can go. Do you understand? Yes. So you can literally do 0.2 is still a mini lot size, and if you're doing 0.2 for every 1 pip, it is $2. Is that clear? Just, it is a law. Nothing changes this law. That is the law. Which, when you follow it, you can be able to know the amount of dollars, or you can be able to know the value of the pips you have made in dollars based on the lot size. And then for every micro lot, for every 1 pip movement is 10 cents. All right, it's 10 cents. 10 cents for every 1 pip movement using the micro lot size, you make 10 cents. Then for every 10 pip movement the market made using a 0.01 lot size, it's equivalent to $1. Is that clear? All right, so let me show you a picture here to explain it further. So a standard lot size is 100,000 base unit of a currency. A mini lot size is a 10,000 base unit of a currency, of a base currency. A micro lot size is a 1,000 unit of a base currency. All right, same with a nano lot size. Now look at how you can comfortably, another way you can know the value of a pip by doing this simple calculation. Let's assume that you took a trade on Euro USD with one standard lot size, and that trade made a 1 pip move. Look at its movement value. This is the pip. All right, the movement value here is the pip, which means if you watch my previous video on pip, I explained it. All right, percentage in point or percentage in price. Do you understand? So this is, the movement was just 1 pip, and the lot size you use to execute that trade is one standard lot size. Now this is this is what it means, that if you're executing a trade with one standard lot size, you are buying the 100,000 base unit of a currency. So how do you do the mathematics to know the value in dollars, the value of this movement in dollars on one standard lot size? You are going to multiply your pip by the base, or by the unit, or the base unit. So that means, since it made 1 pip movement, you're going to say 0.0001 multiplied by 100,000, the value is $10. You see that? So this is another way you can do that. So if the market did 10 pips, or let's say 11 pip movement, let's say it is 11 pip, you're going to do 0.0011 multiplied by 100,000. You're going to get $110 as the value. Is that clear? So you're going to use this same formula, all right, to do the maths for any pip movement you want to know the value in dollars. All right, yes. So let's just assume that you're trading with a mini lot size. All right, this is how you do the same formula. You're going to multiply 0.0001 multiplied by 10,000. You know that the value is $1. Is that clear? So basically, lot sizes are used to control risk in forex trading. Most beginners traders fail to understand this simple concept, and that is why they all have blown accounts. Lot sizes are used in correlation with your account size. They are also used to know the value of a pip in money terms. Just remember that one standard lot size is the 100 contract size of the base currency. So for example, when you buy one standard lot of Euro USD, it simply means that you are buying 100k of Euro with US dollars. The pictures above explains everything you need to know about lot sizes and how they can be used to know the exact dollar values in forex trading. So please, you're going to stick around to this video. I'm going to be calculating it in another way for you to understand. All right, this will give you better understanding. And again, the part 2 of Forex 105 is going to tell you how lot size and leverage can be used simultaneously for the benefit of a trader, and the right lot sizes you need to use for a particular account size. You know, most people are using $100 to trade, and they're using a standard lot size to trade on that $100. That is why you see them, they complain of blown accounts. So you need to stick around and watch the next video. All right, and from the next video you'll be able to know the right lot size you're supposed to use for a particular account size as a trader. That way you can never blow that account. As long as you are skillful, as long as you know what you're doing, all right, you'll never blow that account. And please, I want you guys to understand that you have to follow us, you have to subscribe, all right, and you have to share our videos, okay, to your friends. Let's build a strong community of forex traders. Is that clear? Because I'm giving out this content for free, and I want you guys to also give me feedback through your subscription, subscribe. And if you need a proper training, a proper mentorship, because that is what we stand out for, you can always visit our website at www.prekani.com. Sorry guys, www.prekani.com. Now let's do this quick mathematics before we call it a day. Calculating forex profit using lot size, using the examples I have given to you guys above. Now let's do the maths. We want to know the profit and loss, number of pips, number of lots, and profit or loss. Example, let me make you understand this thing. Profit or loss is equals to the number of pips multiplied by the number of lots. That is how you get your profit or loss. Example, let's say Euro USD was ready for a buy, and our stop loss is 30 pips, and our take profit is 90 pips. All right, I think this is an error. Sorry, this is an error. It will be corrected. All right, I'm really sorry about this, guys. So now we're going to multiply our stop loss and take profits by the number of lots. That means for a standard lot size, we're going to say 0.0030. Remember this formula. All right, now the movement is 30, and we're going to use it to multiply, all right, our base, because we are using a standard lot size to take this trade, for instance. Now let's say for a standard lot size, 30 pips, for you to know the value of 30 pips in dollars, you're going to do 0.0030 multiplied by the units, which is 100,000. Your stop loss is going to be 300, because when you multiply this by 100,000, it's going to give you 300. This is how you know the value you're risking on a trade. All right, Yeah, but right now it is very, very easy. The MT5, the new version of MT5, all right, can allow you to put your stop loss without you doing all this calculation. You will know the value, because as you're moving your stop loss to where you want it to be, you're seeing the value alongside. So when you say you want to risk $300 on a trade, once you just go there, move your stop loss at $300, you can execute the trade from there. Do you understand? So you will save yourself the stress of doing all this mathematics. Okay, but the reason why I'm doing this, so that you will know as a trader, in case you find yourself in an environment where you will be asked to do these things yourself. All right, so then you want to know the value of your 90 pips take profit. The same formula, 0.0090 multiplied by 100,000. All right, the value of 90 pips is $900. This simply means that the value of your 30 pips stop loss by a standard lot size is $300, and 90 pips take profit is $900. Most students would ask me, Mr. Possible, please, how much is 1 pip worth of a standard lot? The answer is this: the dollar value per pip for each standard lot is usually $10. This is a law, it does not change. Now, most times people say they traded Forex and lost some good amount of money. No doubt, they might be saying the truth, but the problem with such persons was their inability to understand the use of lot size and identify which lot size is suitable for their equity. Now, when you hear the word equity in Forex, we're talking about your account size or your trading account size. Some traders, due to ignorance, might assume a standard lot size on a 500 account. In reality, the appropriate lot size for such an account should be 0.05 lots. 0.05 micro lot, which is a micro lot size. Now, using a standard lot, which is 1.0 lot on a $500 account, especially with a 50 pip stop loss, can be extremely risky if the trade becomes a losing one. It could wipe out the entire account, resulting in a total loss. Your money would be gone, blown and forgotten. So it is crucial to understand proper lot sizing and risk management to avoid such catastrophic losses. So you see, people will come, your trading account size is $1,000, and then you get overwhelmed with what all these online traders are doing, and then you go and take this trade with one standard lot. You go and take a trade on your $1,000 account with one standard lot size, and then your stop loss on that trade is maybe 50 pips. Automatically, when you lose this trade, you have automatically lost 50% of your equity. So imagine you having 2 losses on a row. You've blown your account because it's not a professional way to trade. But if it goes in your direction, yes, you can double this account in less than 5 minutes. You can make so much profit, but that is not the standard. It is not sustainable. So we do what's sustainable, except you have decided to take high risk on this equity. All right, but the proper way to do this is the right lot size for this is going to be explained in our next video. Okay, so you must be so tired by now. Kindly take a 10 minutes break. This is to prepare you for the next level. Enjoy your break time. Like I said, we're going to continue from the next video. Have a wonderful day ahead, and don't forget that you have everything in you to become a successful trader. Okay, and we are still open for mentorship. The right way to come into Forex trading is through a mentor. It is good for you to be informed with the content we're creating on YouTube or we're making available on YouTube, but you need a mentor to be properly trained. So do well to visit our website and connect us from there. All right, thank you. Our website is prekani.com, www.prekani.com. See you on the next video. Bye.